On one level, there really weren't a lot of surprises on Wednesday. Everybody knew that the Fed was going to raise interest rates. They did, 10 times in a row. We've got the highest interest rates in 16 years. They've gone up 5 percentage points, 500 basis points. But actually, there was a move afoot, a really compelling argument that was made that they ought to pass. Hawkish pause, it was called by Rob Kaplan, the former CEO of the Dallas Fed. And it really did pick up some momentum. Rob Kaplan joins us right now. It's good to have you with us.
Thanks, David. Good to be with you.
That was one of those terms like irrational exuberance or something. Nobody did. It just sort of, everybody said, that makes a lot of sense. And not because we're not trying to kill inflation, because of the banking situation. You think the banking situation is far from over?
Yeah, I'm concerned about the banking situation. And here's why. We'll get past how we could have missed this. But once this has happened with the asset liability mismatch, basically bank equity across the country has been marked down. And the thing that's challenging is normally when we're having a discussion about banking concerns, it's usually after we've been through a credit cycle. This is actually before we've been through the credit cycle. We're not terribly well positioned for the credit cycle. What I mean by that, unreserved write-offs in commercial real estate, C&I loans, we're not terribly well positioned for what's about to happen because the rate increases have wiped out the market value of a lot of capital that was supposed to buffer those losses.
Okay, so pause right there for a minute. So they get money in, they're going to invest it just like anybody else invested, but they buy U.S. Treasuries, for example, long, maybe 30-year bonds. But when interest rates go up, those assets go down in value. So just like we make a bad investment in Google or something, we lose money.
So I would say the state of Texas is blessed with a lot of chiseled bankers. They've been through, many of them have been around for the 80s and the oil sell-off and the financial crisis then. And so a typical banker in the state, in my experience, will not actually buy long-term treasuries or mortgage-backed securities because they know the risk of an asset liability mismatch. So many of our banks did not make that mistake, but some big banks in this country did. And what's happened is equity owners around the country have said, I don't care whether you did it or not, and depositors have said, if I have uninsured deposits with your bank, even if you don't have this problem, I want to move to a bigger bank. And to solve the problem, now we've merged Republic Bank with JP Morgan. Okay, in one sense, okay, that's good, that's settled that down. In another sense, it's made the issue even worse because now you have 3 classes of banks. I said when I talked to you a month ago, we had 2 classes of banks. The big GSIBs and the big regional banks, that's about 10 or 12 banks out of 4,150. And you got small, mid-sized banks. Now we have 3 classes. JP Morgan, okay.
And everybody else.
And then the big banks, and then everybody else. So how would you like to be a competitor like in California with First Republic? You're no longer competing with First Republic, you now compete with JP Morgan. JP Morgan can pay a depositor 2%, where you have to pay that same depositor 4 or 5%.
Just to attract the money.
You have a natural competitive disadvantage. And the problem is it creates a great onus, and we're seeing it play out in the stock market.
But that means the loans
banks.
that they're going to make, if they're having to pay more for the money,
right,
then the loans they're going to make, either they're not going to make them or they're going to have to charge more.
Well, I'll tell you what they are doing, because I'm talking to a lot of bankers throughout, not just in the state of Texas, but in the country. What most banks are doing is they're saying, okay, we don't like where our stock is. We would love to raise equity, but this is not the time to do it. We don't want to merge. And the only thing left to do is shrink the loan book. And every bank I talk to is shrinking the loan book.
Well, and we're going to shrink banks too. I mean, obviously, we've already seen a little bit.
That's what it means.
And we've seen a lot of shrinking, over the last decade or so, a lot less banks than we used to have. But I'm going to go back to where we were a month ago. We're going to turn into Canada, aren't we? A handful of banks?
No, well, let's put it this way. Here's the problem. I don't think we can or should turn into Canada. A lot of people say, and for your listeners, Canada doesn't have very many banks.
Right.
Fine. But on the other hand, one of the distinctive advantages of the United States is small, mid-sized businesses spread throughout this country. and their primary source of capital is the local mid-sized bank. If you lose those banks, I would argue you're going to lose access. Okay, you're not going to have as much entrepreneurship. You won't have as many small businesses. Why? Because big banks, it's not that they don't want to make small business loans, it's not economic. It doesn't make sense for them to put all the expense into making a small loan. They'd rather use that same expense and make a bigger loan.
Yeah.
I don't blame them.
Costs just as much to service a
I
big
don't
loan as a
blame
small
them.
loan.
And
So this is why you say, if this is a 9-inning game, we're only 2 or 3 innings into
we
it?
are. And so here's the issue I'm very worried about. We've gotten our muscle memory, we've gotten very used to this country. Okay, hey Rob, don't be so excited about this. When we go into this downturn, we'll have a big fiscal stimulus. Fed will print more money, and it'll all work out. I don't think I wouldn't assume that's going to be the case this time. We're starting to be a little bit more worried about the dollar and its supremacy globally, which has been key to this. I don't know how much capacity we have to get more leverage in the next fiscal stimulus. Can the Fed really have a bigger than a $9 trillion balance sheet? You need small, mid-sized banks, therefore, to be the muscle to lend to small, mid-sized businesses if we're going to grow out of this next
Well,
downturn.
we're in the big middle of this. How do you fix this now?
Well, I said this last time I talked to you. I still believe, as unpopular as it is, I feel strongly the right thing to do is raise the deposit insurance limit for at a minimum business accounts, payroll accounts, maybe not savings accounts, but for business accounts, I would raise it to $3 or $4 million. That won't totally fix it, but it'll go a long way to fixing
de
it.
facto, there is no cap right now. I mean, right?
No,
We
wrong.
bail them out. Well, I mean, it may say so on the side.
We bail them out if
250,000.
they're systemic. I think the jury's out in the minds of depositors. Will they bail us out if we're small?
Right.
And I don't know. They say that, well, can't tell what they say. I think they would, but on the other hand, I won't mention names. One public official said only if it's systemic. Another public official said depositors don't need to worry. The truth is it's vague. And given that if you're a treasurer of a company and you have $1 million or $2 million payroll account, it's asymmetrical. If you have an option to do something safe, go to J.P. Morgan.
You know,
go
the
to a bigger
timing
bank.
for this is just not very good. I mean, we've got
Stinks.
Well, I mean, if Janet Yellen, the Treasury Secretary, is right, you know, we're gonna bust the budget in a month.
Yeah. So
And it's not a good time to be talking about printing money or guaranteeing things that aren't guaranteed.
No. So I think a structural change. If I were in the government, and I know we'd get our brains beaten, and that's why I'm not a politician, because I'd get clobbered. I would propose this. I think this should get done. It will go a long way to bolstering the banking system. By the way, in terms of the budget standoff, I hate the tactics, I hate the threats, but do we need to have a real conversation about fiscal spending? We do. In my opinion, right now, if I were at the Fed and if I were at the Dallas Fed, I'd be saying everywhere I went that we need other parts of the government other than the Fed to be showing more discipline if we're going to fight inflation.
And that's going to take us back to entitlements, and then that's going to be a
Yes.
long argument. So let me ask you more. Let me come back to
Well,
where we are right
the
now.
Inflation Reduction Act is in long run disinflationary, in the short run highly inflationary. We need to have more discipline now if we're going to fight inflation. That debate needs to happen.
So the problem, and you've isolated, and you make a compelling argument about the banks. Now tell me about the rest of the economy. Does this drag the rest of the economy down, or can we sort of put a wall around the financial system?
It will amplify a slowing. But one thing I would tell you that's also going on, I think monetary and fiscal policy, this hasn't been talked about much, are working at cross purposes right now. There is an enormous amount of money in the fiscal pipeline that was authorized from the American Rescue Act, still hasn't been spent, won't be spent till the end of 24, billions and billions of dollars. Dallas and Fort Worth, I can tell you, each have over $1 billion that hasn't been spent yet. It will be spent. And in addition, I mentioned the Inflation Reduction Act and a number of these big fiscal programs. The money is being spent this year, next year, and the year after. The reason we're not slowing as much, even though the Fed is raising rates, the fiscal impulse is still there. And so Eventually it will dry up. And when it does, you're going to see these rate increases bite much more than people might be feeling right now.
Yeah.
And
So it's a long time coming. Yeah, even Jay Powell said at his news conference Wednesday after the Fed meeting, he said, I can't believe we've raised interest rates this many times, 5 percentage points, and we still have 3.5% unemployment.
because you've got, I think, what they need to call out, and I'll say it again. Jay has said, we're going to, and I respect Jay and I know him well, we're going to stick with it until we get to 2% inflation. I think the Fed can get inflation down to 4-ish. I think without other parts of the government being involved, I think it's going to be hard to get much below 4. It's going to be sticky. And I would rather raise his hand and say, you know what, we're going to do our part. You can be dead certain we're going to do our part, but we need other parts of the government. Let's fight this in a whole, and that's what I'd be saying. And I'd be saying if I were at the Dallas Fed. And as an individual citizen, I'm saying it now.
And you make a compelling argument. You're the perfect combination from the Fed to vice chairman of Goldman Sachs, but also you're a teacher, and you've taught us a lot today. Rob Kaplan, our guest. Good to have you with us as always. Thank you, sir.
Great to talk to you, David.
Thanks. I'm David Johnson. Oh, for more, go to our website. Go to krld.com/CEO. I'm David Johnson, News Radio 1080 KRLD.